Hello everyone, hope you all are doing well. So now we are done with all the IAS and IFRS lecture. So from now onwards, we will start the SBR technical article. What I am going to do with the SBR technical articles, I will attach all the technical articles which are on the ACCA site. Then in the day wise, we will discuss 3 to 4 articles per day. Don't worry, this will not take your further time because I have written the main crux of this article. You do not need to read the complete article from the ACCA site. Rather than you can follow these articles. Okay, in today's lecture, we will discuss 3 articles which I personally think very important for your SBR exam. So today we are So now the article number 1, which we will cover, is about the accounting ethics in digital age. Digital age being in today's world, how ethics is very important. Why ethics matter more in the digital age? We all know in the digital age means data analytics, cryptocurrencies, cyber security, sustainability are very, very crucial concept in today's world, and there are confidentiality issues, social norms, culture, environment, wealth distribution, all are associated or linked with these issues as well. That's why ethics in every sector is very, very important. But we are an accountant, we are an ACCA, so we have to follow the ethics with respect to the accounting and reporting. So, based on that, today we have an article why ethics is very important in the digital age. Let's start reading it. Why ethics matter more in the digital age? Accountants means we need more than technical skills. Accountants accountants need more than technical skills. They shape the moral culture of the organizations. We are not just in the organization to do the debit credit to tally the balances. We are more than about the debit credit. Digital technologies, AI, artificial intelligence, big data, cryptocurrencies, cybersecurity introduce new ethical risks. Yeah, we all know whenever there is a new innovation, and behind every innovation, there are some issues, some risks as well. So, in order to counter and in order to mitigate those risks, there are ethics. Ethical dilemmas are complex, influenced by culture, social norms, environment, wealth distribution, and relationships. Strong ethics mean trust. Stakeholders continue to rely on accountants. In order to rely the user, the general public on the accountants, on the work of the accountants, we have to comply with the strong ethics. Means we should be integral, we should be independent, we should work with the due care and diligently. Now, fundamental ethical threats. There are 5 threats we all know, we have been studied since we were child. Threat, self-interest threat, familiarity threat, intimidation threat, self-review threat, advocacy threat. Before reading the content, let's brainstorming about the threat. What is self-interest threat? Self-interest threat means you or any of your family member has a financial or personal interest in the organization. You have a shares, your father, your daughter, or your any close member has a share in the organization. Now, meaning judgment influenced by personal financial interest. Digital example, because we are covering it with respect to the digital age. Holding crypto investment while auditing a crypto exchange. Familiarity threat means personal or close relationship with the client. Too close to client employer lose objectivity. Long-term IT consultant turned auditor of same firm. Intimidation threat. Undue pressure to act unethically means you are influenced or you have a pressure to pass some unethical adjustment to do the unethical reporting and accounting. Hackers threaten to leak data unless accountant stays quiet. Self-review thread, reviewing on previous work, evaluating an AI model previously developed for the client. It means the model developed by you and now you are reviewing or evaluating it. Advocacy threat means promoting the client personal interest or position, defending platform company such as Uber in employee right dispute. It means, let's say you work on the Uber app or on the Uber company. Now there are some ambiguities or some bugs on the Uber side, and the customer or the employee asks for the dispute or for the claim. Now you are taking the side of the Uber rather than do the justification. You are not promoting the equality. You are just doing the one-sided. Advocation means promoting your client personal interest, your client behavior. Now, key digital age challenges. What are the challenges which we have to face in today's world? Cyber security and data theft. Whenever there is our cyber security, the opposite is a data theft, means risk of losing the confidential information. Now there are risks associated with the cyber security, data loss, financial harm, reputational damage. Of course, if there is some heinous crime, then the reputation will be at stake. Accountant's duty. What will be the accountant's duty in this case? Protect confidentiality, integrity, and objectivity. These are the main pillars of every organization. Must ensure controls and compliance with data regulations, GDPR, etc. Challenge number two, platform-based business models such as Uber, Airbnb, YouTube, etc. Ethical issues. Employee versus contract status, which we have covered above. Fair treatment of suppliers and customers in case of BNB. Balancing profit versus stakeholder rights. Now, distributed ledger technology, DLT, blockchain. Blockchain is not a single account. In the seconds, in the micro or nanosecond, the transaction, the ledger updated immediately. So in the blockchain, there is shared decentralized database, example UK land registry. Risk data breaches, hacking, large scale economic consequences. Accountants must assess risk, honesty about expertise, and public interest. This is the Web3. Blockchain is one of the most in demanding or important skill. If any person want to pursue blockchain after ACCA or with the ACCA, these are the emerging skills. Now, big data and artificial intelligence. Big data means large storage of data. Let's say if I talk about your Google Drive, you have a Google Drive and in which all the data have been stored. By chance, you are uploading your personal data on the Google Drive, and by chance, by mistake, you have shared that link with any person. Now you can think what will be the disaster. Big data and artificial intelligence AI benefits faster evidence-based decision. Yes, it is, but there are risks as well. Bias and discrimination in AI models, job displacement, system failures, safety issues. Misuse of data without proper consent. Accountants must check governance, assurance, and transparency in AI use. Ethical principles at risk in digital age. Professional competence means you have to be competent enough. You should work with due care, with due diligence. Lack of digital knowledge may compromise judgment. Yes, if you are not competent enough, then there should be some hurdles. Lack of digital knowledge may compromise judgment, professional skepticism, confidentiality, more frequent breaches in digital system, integrity and objectivity. Pressure to Pressure from data misuse, stakeholders, or hackers. It may impair the objectivity of the accountant. Now, steps to address ethical dilemma. Decision making framework for accountants. What are those decision-making frameworks for accounting? The number one is identify the nature and context of the dilemma of the circumstance due to which this occurred. Assess who is affected, rights and interests. Consider rules, codes, and laws. What are the applicable laws? What are the rules and regulations in that sector? Evaluate arguments for and against, like who is the culprit, who is the guilty. Okay, after that, you have to discuss with the formulate a balanced solution. Means it should not like that you are promoting your client's side. It should be balanced. There should be equality, justice. Consider negative consequences of both action and inaction. Means your action should be balanced. Now, in the every article, in the end, I have written a main crux, main summary. So once you read the above things or the content, then in the end there is a main summary which give you the overview of the entire article. Technology changes the context, not the fundamental of ethics. Means fundamental, the principles are still same. It just change the context. Like in the audit, the ethics which we use about the auditor perspective. But now in the accounting, we will use from the perspective of accounting. Now, this is the accounting in case of digital age. So, digital means technology. So, you have to use the ethics with respect to the digital, like cryptocurrencies, blockchain, AI, data, and all these. Accountants remain custodians of trust. This is very important. Digital age requires greater awareness of new risks associated with the innovative technologies. Continuous learning, AI, DLT, cybersecurity platforms. Application of timeless ethical principles in new situations. Now, in the end, there is a visual infographic, text based for word. Let me show you. Look, digital age ethics for accountants, cybersecurity, data theft, confidentiality, platform models, fair treatment of workers, DLT, blockchain, public interest, and accuracy. AI, big data, bias, transparency, and governance. Apply ethical principles such as integrity, objectivity, competence, due care, confidentiality. These are the fundamental principles. Now, article number 2, the conceptual framework for financial reporting. You have been studied this thing from the start of your ACC as the entire accounting and reporting based on these frameworks. Let's give an overview. Purpose of the conceptual framework. Why conceptual framework? It's important. It's like a Bible. It gives the roadmap, what to do in this case and how to do if there is a particular situation. This conceptual framework underpins IFRS standards and serves three roles. Help IASB International Accounting Standard Board develop and revise IFRS standards. Help entities when no IFRS applies or choice of accounting policy is allowed. There is a discrimination. If the entity has the choice of accounting policies, then they will do their own. If you watch the IAS 8 lecture, Changes in Accounting, Estimates, Policy, and Prior Period Error, in which there are few factors. Based on that, IFRS allowed the entity to change the estimate from LIFO to FIFO or FIFO to FCO. It's not in the choice or in the will of the entity. If it's in the will of the entity, then they will deliberately change the accounting policies based on their outcome. Now, help stakeholders means general public users interpret and understand IFRS. Now, IAS 1 is replaced by IFRS 18. Why it is replaced? Because IFRS 18 gives the more accurate, better representation such as faithful representation, better idea, and it's easy to understand for the non-financial persons as well. Investors are not all times the financial persons. Sometimes they are a non-financial persons as well. Note, IFRS standards override the framework if a standard differs. IASB explains why. Key addition. Steward assessing how management uses resources. Users focus on future cash inflows, amount, timing, and certainty. Management stewardship of resources. Stewardship is the practice of managing other person's assets, or you can say resources. Now we have chapter 2, qualitative characteristics. What are the qualitative characteristics? And let's read it. Fundamental characteristics and enhancing characteristics. By the term fundamental means relevance and faithful representation, means the information should be relevant and it should provide the faithful representation. Faithful means correct, true, and fair. Relevance. Information helps decision making. It should be relevant. Faithful representation. It should be complete, neutral, free from bias or error. Substance over form. Enhancing characteristics means comparability, verifiability, timelines, understandability. These four characters should be in the enhancing. Now we have prudence. You all know about the prudence from your teenage. Prudence and neutrality. Prudence, cautious judgment under uncertainty. Supports neutrality, avoiding biasness. Not the same as asymmetric prudence. IAS 37 example, provision versus contingent liability. You cannot record provision for the future operating losses, also for the future repair maintenance. IAS 37 does not allow to record the provision as per the prudence. Use of estimates does not harm faithful representation if disclosed transparently. There is a keyword transparent, means transparency should be there in the disclosure. Now, chapter 3, financial statements and reporting entity. Objective of financial statement: provide information on assets, liabilities, equity. Equity means net assets, income, expenses. These are the accounting cycles. 5 principles of the accounting: asset, liability, equity, income, and expenses. Stewardship of management. Key points. Financial statement prepared on a going concern basis, means you have to evaluate whether the entity will able to continue, means to foresee in the foreseeable future, that is 12 months. Comparative information required, means prior year or the last year figures, meant statements, SOFP, P&L, cash flows, changes in equity, notes. These are the 5 components or units of the financial statement. Statement of financial position, profit and loss, OCI. Cash flow, changes in equity, and notes to the financial statement, in which we provide all the relevant disclosures. Now, chapter number 4, elements of financial statement. Elements, there are 5 elements which we have covered above: expense, liabilities, income, assets, and equity. So asset means present economic resource controlled due to past event. Now they have changed the definition. Present economic resource controlled due to past event. And the liability means present obligation. Obligation means it's a responsibility, it's an obligatory to you to transfer the amount or the resource. So present obligation to transfer a resource due to past event, means the condition is the past event. There is something from the past. You have a right or you have a control from the past. Equity, residual interest after liabilities, means net assets. Total assets minus total liabilities. Residual means remaining portion. Income, increases in assets, decreases in liabilities. Equity exclude honor contributions. Expenses decreases in assets, increases in liabilities. Equity down, excluding honor distribution. By reading this, it's look very small and simple, but I can tell you the examiner asked questions of almost 6 to 8 marks on these definition and elements. So be prepared and try to link with relevant head with these 5 elements of the financial statement. Now, chapter 5, recognition and de-recognition means whether to recognize and de-recognize. This is important with respect to IFRS 9. Okay, recognize an asset liability if it provides relevant information, faithful representation, benefits greater than cost. Okay, I have a question. What if the benefit is less than the cost? Then what will be the treatment? I want to know. I want to check your knowledge. You are just 1 week away from your exam. So tell me what will be the implication if the cost is greater than the benefits, means benefit is less than the cost. Future benefit is less than the cost. Please comment down. This is very important and I am hoping that this concept might test in your exam. No fixed probability test. Different IFRS standards vary. Even low probability items can exist. Disclosure may be more useful than recognition. Yes, in certain cases, disclosures are more useful. De-recognition should faithfully represent assets, liabilities retained, the change from the transaction. Chapter number 6, measurement. Selection depends on relevance, faithful representation, cost versus benefit, measurement basis. Historical means past, adjusted for depreciation and impairment. Current value, 3 types. Fair value, value in use, current cost. Fair value means exist value, market based. I have explained in very detail in the IAS 36 lecture number 1 of SBR. Current value, 3 types. Fair value, value in use, fulfillment value means present value in which you can continue. Specific present value of cash flows. Current cost, entry value, cost to acquire, settle now. Now there are trade-offs. Historical cost may be irrelevant for long-term assets derivatives. Yes, because derivatives and long-term depends on the futures. Fair value may be less relevant for items held for use. Yes, it's for the long term. Then fair value means market value. It could be changed anytime. PPE in production. Chapter 7, presentation and disclosure key principles, P&L as default. Income expenses included unless OCI gives more relevance, faithful representation. Component with rates to equity will go in OCI. OCI items reclassified to P&L only if it enhances relevance, faithful representation. Examiner can give you a scenario and ask you to pick the specific items which can reclassify into OCI. Now you have to think. It's better to think now rather than thinking in your exam day. So you can compare which approach you want to follow, either to think now or in your exam. Debate, some argue all OCI, PNL, others none, framework case by case basis. Crux takeaway. The conceptual framework provides the foundation for IFRS standard. Focus, useful, relevant, faithful, represented information for decision making and stewardship. Core building block, objectives of reporting, qualitative characteristics, elements 5, asset liability, equity, income, and expense. So now I think we are almost done with this article number 2 as well. Recognition and de-recognition, measurement basis, presentation and disclosure. Standards may depart from the framework, but principles guide consistency and transparency. Then again, you have visual, infographic, text-based forward. The conceptual framework, 7 chapters. Objective means economic decisions plus stewardship. Qualitative, relevance plus faithful representation plus enhancing. Remember the enhancing. Can anyone tell me, please? Comparability. Okay, I think you guys forget. Financial statement and entity, assets, liabilities, equity, income, expense. 5 elements. Elements, 5 building blocks of FS. The above one. These are the recognition and derecognition, useful cost benefit analysis, measurement, historical cost, and current values. Presentation, disclosure, PNL versus OCI means you have to think either the classification will go in PNL or in OCI. Now, guys, article number 3, and I personally like this article very well because this article is all about the real world, the real issues, accounting for cryptocurrencies, and most probably, maybe this article can test it in your exam, even though it has tested significantly in the past sittings. But yeah, again, this can be tested as well. Accounting for cryptocurrencies, IFRS treatment. Before reading this technical article, mostly think that the cryptocurrencies are statement of cash flows, these are financial assets, these are inventory, and these are intangible assets. But after this entire article, you will have a better clarity what is a cryptocurrency and what will be the treatment of cryptocurrency as per IFRS. Key context. No specific IFRS exists for cryptocurrency. So first thing is clear that there are no specific IFRS for cryptocurrencies. Now, must apply existing IFRS standards by annual candidates and accountants means we in practice must identify these 3 things. Must identify possible IFRS standards, assess applicability, justify why a standard is appropriate or not. Then I have divided into steps. Step number 1, consider cash equivalent, IAS 7 cash flows. IAS 7 cash flows, IAS 32 presentation. Define cash and cash equivalents. Cryptocurrencies, not cash. Why? There is no legal tender, no universally accepted as medium of exchange. Universally means it not allowed by the entire world. There are few countries which allow the exchange in case of cryptocurrency, but it is not allowed the universally. High volatile, high risk, so not short term, highly liquid with insignificant risk. Conclusion cannot classify as cash or cash equivalent. Look how I have written this article. So with the every standard, it will give you the better clarity why and why not cryptocurrency will be accounted for as per this standard. Now, step number 2, consider financial instrument, IFRS 9 financial instrument. Cryptocurrencies, not financial assets. Can anyone tell me what is the definition of financial asset? Cash, cash equivalent, contractual right to receive cash, or equity. So now identify these factors of the IFRS 9 definition. Cryptocurrency is not financial assets. Why? Because not cash as per IAS 32, not equity debt instrument, yes, no contractual right to receive, deliver cash or another instrument. Please tell me, are you getting these things or not? Conclusion, not a financial asset. It's not a cash, it's not a cash or cash equivalent, which we have covered from the IAS 7 perspective. And there is no contractual right to receive or deliver cash or an other instrument against the cryptocurrencies. Now the conclusion is not a financial asset. Step number three, consider intangible assets. Yes, IAS 38, intangible assets. Definition, identifiable, non-monetary, without physical substance. Without physical substance. So link all these factors with the cryptocurrencies. Cryptocurrencies qualifies because it's separable, can be traded, transferred, sold. Yes, you all know. It's a non-monetary IAS 21. No right to receive fixed currency. Yes. No physical substance. Yes, that's why it is classified as per IAS 38. Measurement model. IAS 38 cost model, amortization, impairment, but cryptocurrency revaluation model only if active market exists means Bitcoin. Fair value IFRS 13 if active market available. Revaluation gain OCI unless reversing previous loss in PNL. Revaluation losses PNL unless covered by revaluation surplus. Useful life generally considered indefinite, no amortization, but annual impairment test. Now, guys, step number four, and I think this will be the last step of this article as well. Let me check. Yeah, there is another step. Step number four, consider inventories IAS2 in limited cases. IAS2 inventories relevant if held for sale. Do not consider it as per IFRS 5. For IFRS 5, it must be your known current assets and as per IAS 16. IAS2 inventories relevant if held for sale in the ordinary course of business. Ordinary course of business means you are a broker, you are a CDC. Broker trade of crypto, measurement lower of cost and NRV normal entities. Fair value less cost to sale if broker trader. Step number five, disclosure and other IFRS links. IFRS 18, the new standard, presentation and disclosure. Disclose methods, assumptions, judgments in recognition and measurement, help users understand risk, valuation method, fair value determination. IAS 10 events after reporting period, material post period, changes in fair value, disclose as non-adjusting events. Adjust non-adjusting event means condition did not exist at the balance sheet date. Now there is a summary table, IFRS, IAS standard, applicability and treatment. You should read it by your own. Now in the end, there is an exam application tip. Structure your answer by testing each possible IFRS standard. Don't directly jump to the conclusion. Say why it might apply and why it does not. Conclude with IA. Okay. Conclude with IAS 38 default, which we have covered above. After that, you have to or IAS2 if it is inventory means in the ordinary course of business, such as you are a broker or a trader. Always linked to disclosure and judgment since crypto is a high risk, volatile, and audit relevant. There is a diagram accounting decision flow of cryptocurrency. You have a crypto, then cash, financial asset, intangible assets, IAS 38, inventories, default treatment, IAS 38. These are the main crux or the complete diagram which we have covered above. So guys, now we are done with the three technical articles. Tomorrow we will discuss further 3 to 4 technical articles. Then we will left with just 2 or 3 articles as well. There are total 8 to 9 technical articles. Don't worry, I will cover each and everything. So take care and goodbye.